All right. Hello, everyone, and welcome to this webinar. My name is Sachin Pulil, and I'm your digital admissions coach. This is the Education Loan Masterclass with Miss Chandini Sehgal. So thank you guys so much for coming. I knew it was a little bit of short notice, and I'm super glad that you guys are here. Another thing that I want you to know is this is actually not like a sponsored session. Like, HDFC is not paying me or anything. And I just spoke with Miss Chandini, and she and I sort of had the same thought. And then when a lot of people apply for education loans, they don't really understand what they're going into, and they don't understand when they need to do it. So a lot of my students have been asking me a lot of similar questions about loans, and even I'm not like particularly clear on the whole education loan, the whole game. So what I want to do is I wanted to bring in like an expert to the channel, to our page, to help answer all of your questions, and that's what this session is. Okay, so thank you guys so much for attending, and now I will pass it on to Ms. Chandini Sehgal to begin her presentation.
Great. Thanks, Sachin, firstly, for having me here. It's always a great opportunity to be able to share information about education loan. There are always so many questions, and it is a very important decision for everybody to take because it's a huge chunk of money that we're investing towards education. So firstly, some of the common questions that we face is, Sachin, you can go to the next some common options that we have to fund education. Firstly, are scholarships to begin with, and there is nothing better than getting scholarships. But unfortunately, most of you would either not be getting entire scholarships, and there's only a small percentage of people who end up getting scholarships anyways. So one needs to look at the second best option there. And one of the common things that we see people do now is go for an education loan. Earlier, self-finance used to be the second best option that people used to opt for, because awareness about education loans, or even the way education loans worked in our country a few years back, was very, very different from what it is today. It's almost become like very clear choice now, and the reasons for these, Sachin, will move to the next slide. So I'm going to firstly take you through reasons if some of you are still considering the choice between self-financing, which is, digging up into your savings, or your parents wanting to sponsor your education, versus education loan. What is the better option for you? So firstly, when you look at an education loan gives you tax benefits, and these are really attractive. I'm going to get into details of all of these in the upcoming slides. But that's one thing that makes it a very smart financial decision. The second thing is that you don't end up paying in a very large chunk right at the beginning. You are paying in smaller chunks. You're literally doing your education on EMI because your repayment starts post-course completion. So that's the second benefit. The third one is very important, and not too many people are aware, is the TCS on foreign remittances. Now, if you are going to send foreign remittances or to pay for your education from India, you will have to pay 5% tax on this, whereas on education loan, it's only a 0.5%. So there's a clear saving of 4.5% right there. Also, we've seen fluctuation in USD rates, INR, and most of you plan to go to US. Because of these fluctuations, the total cost ends up going up by 10-15%, and you may not be completely prepared for this if you're going to self-finance. So when you apply for a loan, you can apply for a larger amount, and therefore there's always this safety belt of having a little extra money out there in case you need to dip into it. What many of us don't consider at an early stage is building credit history, and an education loan becomes a fantastic opportunity for you to do so. Because you need to, have a good credit history to get loans in the future, to get loans at better rates. And these could be any kinds of loan. It could be for a personal loan. It could be for a car or home later on in life. So when you pay your education loan regularly, you build a strong, positive credit history for yourself. And that makes all your future loans much more accessible and cheaper for you. And most importantly, when you're going for education, it's an important decision. And many of the students we've seen end up taking part-time jobs just to be able to pay for that education. And, you may sometimes lose focus on the core purpose of going there, which is focusing on your education there. And it is a hectic life that you will have. So education loan also eases that bit off. So these are, wonderful, smarter reasons why education loan really works better. Most parents around this age would also be around their retirement, and so it's a good opportunity for you to say that, hey, keep this for your future, and I'm going to pick up this loan and pay for it, because you will have, I'm sure, a brighter future there and be able to pay in easy EMIs for the loan that you take. Now, understanding education loan. So if you are choosing the education loan, what are the key features that you should look at? Now, most of us end up starting with an interest rate, and that would probably be the start point and the end point to evaluating whether a loan is better here versus another place where you're going to apply. There's a lot more that goes behind this. So here is a checklist for you, and we will get into details of all of these so that you understand exactly what it means and what you need to check while you're applying. So move to the next one. So one common question that you should ask any education loan company is, what all are you going to cover for me in the loan? Now, tuition fee is just one part of the cost that you will have. There is a lot more. Your accommodation expenses, living expenses per se, will end up being 30 to 40% of the overall cost that you will, end up spending when you're going to go overseas. So one should look at whether your tuition fee, accommodation expenses, even traveling expenses can be covered in an education loan, examination fee, other fees, is all of those costs which are very directly related to your education overseas, is all of that getting covered or not? And when you look at accommodation expenses, both your on campus and off campus accommodation can be covered. However, this is a must check, because not all education loan companies cover all of these things. There are some who will only cover tuition fee and nothing else. So 30-40% of this overall cost you will have to put upfront from your end and plan for that. So while this option is available to cover everything, you should avail of that, and therefore must ask this education loan company that you're applying to whether they offer all of these or not. Now, while we talk about some amount of money that you may need to give from your end, another common thing to ask is, are they asking for margin money? Now, what really is margin money? So when you are planning for your education costs, there is some amount when you apply for that loan that the financial institution may ask you to put in from your side, and they would only fund the balance. Now, this rule changes. Some ask for 15%, some ask for 10%, some ask for 20% to be put in from your end, and then they fund the rest. However, there are education loan companies today who will not ask you for any margin money, which basically means that they will cover up to 100% of the overall cost of attendance that you would have. And that again makes it a very interesting benefit, because on all of this, you're going to get tax benefit then. Now, while we're talking to all of you here, we see that, some of you are planning to go for fall, some for spring, and I'm glad many of you who are planning for the next year already attending a session on education finance planning, because it is important to start this early. Now, we often saw that, people waited for the admits from the universities to come in, and only then would they start the education loan application process. Now, this is something that was followed in the past, but things have changed now. There is an opportunity to start this planning and application process early. And this almost became like a chicken and egg situation that we saw from students, where, they said that we need to show proof of funds. Universities are asking for proof of funds. We are not sure whether we're going to get the loan. We are applying. And, there's this whole year, all your preparation, everything that's dependent on this. So if you wait for the admit to come and then if you apply for an education loan, what if it gets rejected? What if you're not going to get the entire amount? So this almost became like a chicken and egg situation, because some years back, you were not allowed to apply till your admit was in hand, till your I-20 was in hand. Now you can apply soon after you've taken your exams and you know which kind of university you're going to go to, which country you're going to go to, what course you're going to pursue. And as I can see clearly, most of you have a very clear decision already made on the country. So since 63% of you are looking at the fall of next year, I'm sure you've taken your test. This is a good time for you to get started. And if you haven't got your test scores, then just wait for a couple of months till you have that in place. And that's a great time for you to start your education loan application process. There are other benefits of this too. We'll come to that. So the other benefit here is, when you apply and you get your loan sanction done, this same sanction letter is accepted by the university as proof of funds. So they ask you for a solvency letter. So if you're not going to have a solvency letter, which is, a sanction letter turning into a solvency letter, what you would need to do is keep liquid funds in your bank. And most of the time you need to show more than, 20-25% over the cost of the tuition fee that you would be spending, and show that to the university as available funds in your account, which means you're liquidating your savings. And that's not a good financial decision from, even for your parents to just have liquid funds lying like that in the bank. So when you apply for a loan, there is a sanction that you get. You're completely set and prepared about how much loan you will get. Ask for solvency letters. So we, for example, give solvency letters to students, 5, 6, 7, as many universities you may be going to, and show that as proof of funds. It's accepted by universities. In fact, universities now prefer proof of funds to be shown in this format. And so that works two ways. So later on, once your admit is there, the last thing you need to worry about is finances. You're sorted on that front. Another thing that is asked by students is, when I get a loan sanction, do I need to take the entire amount? Because you're not going to know how much of an exact figure of that loan are you going to need. There are different universities. Each one has a different cost. And there is no way you will know the exact amount. You would only know an approximate figure as to how much of a loan you would really need finally. So when you get a sanction letter, supposing you applied to 5 universities, and you know that my higher end of the university is going to cost me 50 lakhs, for example, then and your loan is sanctioned for 50. Finally, the university that you're choosing, you're only going to need about, say, 40 lakhs for that one. You can choose to take only 40. There is absolutely no legal binding that the entire sanctioned amount has to be availed by you. You can choose to take the amount that you need. That too is disbursed to you in tranches, which means that in your first year, maybe you need only 20 lakhs to be given. In your second year, you would need the rest to be given to you for your living cost, or to the university for tuition fee. So it is dispersed in tranches, which works out well, because that also means that the interest is only charged on the amount that is dispersed, and not in the whole chunk, which is, just given to you in one shot, but in tranches, as in when the university asks for the fee to be paid. So that's another thing that works out very well. Sanction letters are valid for a few months. In the current situation, we have seen that students who had sanction letters from us postpone their plans because of the current pandemic and the current situation that we are in. And in that case, we don't need to go and reevaluate your loan unless the university or the course or the country that you're planning to go to is changing. So if all of that has remained the same, one does not need to again go through the process of applying again and having your loan sanctioned. The previous sanction letter will hold good and you will be able to take the disbursement on the basis of that. Now, tax benefits. This is a very important part to understand, because most do not know how attractive these tax benefits. I don't think there is a tax benefit on anything that's available that's as good as what it is on education loan. And that's because your entire interest amount gets a tax waiver under Section 80E. So, for example, if you're taking a loan at, say, 11% and you fall in the 30% tax bracket, then the entire 30% of the amount that you're paying on interest is going to be waived off. So technically, your effective rate of interest falls to approximately 8% odd. If you go to the next slide, you'll be able to see who all can avail of this. So supposing you are not paying for your education loan, but your parents are paying for your education loan, they can avail of this tax benefit. Later on, if you switch and you decide you want to pay for the loan instead, then you can avail of the tax benefits. So that flexibility is there, and this makes your effective rate of interest so low that we mostly see people invest the same money that they would have put behind that education into some other place, probably earn a higher interest rate there while this money is sitting in their bank, because when you take a loan, you're actually getting it at an effective rate of interest of approximately 8.5% because of these tax benefits. So that makes this fantastic. However, what you need to check is, does the education loan company give tax benefits? Because not all education loan companies are authorized to do so. So there is a tax gazette, and we'll show that to you in the next click. When you look at this tax gazette, which is on the right hand side of the screen, that basically is the proof that that organization is authorized to give you tax benefits, and this is a must ask, otherwise you will lose out on this benefit. And especially since everybody does not give this benefit, extend this benefit to their applicants, this is a must ask before you apply. From your perspective, we've seen it is about, will I get a loan? How will it be evaluated? How much of a loan will I get? And what is the criteria that you're going to follow? So most common criteria that any education loan company follows is to understand, firstly, the student's academic profile, which includes your academic track record of the past, your current test scores. We also look at which university that you would be going to, which country you're going to, which course, because employability changes. Now, your employment rules keep changing. In the recent past, we've seen there has been a positive change, for example, for UK. And these things keep fluctuating. So an education loan company evaluates that, because if you're going to be able to stay in the country and work with ease, you'll be able to get jobs in ease and be able to pay back. So that's one important part which is evaluated. An Indian education loan company always asks for a co-borrower to come on board. Now, the advantage of having a co-borrower on board is that you do not have a credit history, you've never taken a loan before, and we're taking this decision of giving you a loan on the basis of your track record. Now, sometimes, having a co-borrower on board increases your chances of getting a loan, because there is somebody who can pay back that loan in case for some time you are unable to do so. So a parent's profile is seen, and a co-borrower always doesn't necessarily need to be a parent. It could also be a blood relative, like an uncle, a brother, etc. So that flexibility is given by some education loan companies. So that's another thing for you to check on, whether that flexibility exists or not. And collateral. A collateral, again, is not always necessarily to be there. There are options given to students, but this is only the option of taking a loan without a collateral, which is called an unsecured loan, is given only to eligible students. And there is an upper cap, and we'll get into details of how that works. So these are three key criteria which are asked for. Everybody who applies for a loan does not always give a collateral in the beginning. However, sometimes during the loan evaluation process, the company may ask you and say, if you have a collateral, put that on board. It's always good to declare if you are able to give a collateral or not. The other advantage of having a collateral there is that you end up getting rates of interest, which may be slightly lower because you're putting a security on board. Now, while we look at eligibility, the application process is just as important. So there are institutions where you need to physically go visit a branch, pick up an application form, submit your documents, and then wait for the decision to happen and the complete education loan process to begin and end with physical visits to the branch. However, today, technology has changed things, and there are many education loan providers who have eased out this process. So you can apply for education loan online, you can submit your documents online, get your sanction letter online. And we've seen that some are also now getting into e-agreements, so you can actually do a digital signature and finish your complete process online. And that makes it so easy, especially today during the pandemic. I think having processes like these have really eased out the whole process of availing a loan. It's made it safer, securer, so much more convenient. So that's another thing to check when you're applying for loan, whether such opportunities are available and offered by the loan provider. Now, there are quite a few documents which are taken while we are evaluating an education loan. KYC documents of students, co-borrowers, income documents of parents. Some of you, I notice, are working, so your income documents would really help out there because you may be funding this on your own there. Academic documents, of course, and collateral if you're going to give a collateral on board. So collaterals here would mostly be documents like FD, or if you're putting a property, then, collateral documents or like those. And there is a process of checking all these documents. So today, during the pandemic, we actually say that, while usually the process of giving a loan sanction is just about a week to 10 days, depending on whether there's a collateral on board or not. But nowadays, because of the pandemic, there are lockdowns. So we recommend to students, if you are applying for loan now, especially for all those of you who are planning for fall 21, you should give a little more time to yourself to be able to, wait for the reward from the financial provider, because there can be a bit of a delay depending on the situation in the city that you are in. If there is a lockdown, it may take a little more time for them to validate the collateral documents that you have given, for example. So a couple of weeks is definitely something you should keep in hand when you're applying for a loan. In regular times, and soon, hopefully, the pandemic should be over for all those of you who are looking for loan next year. Such processes will actually be shorter. We've seen companies give loan disbursement, loan sanctions within a few days, also 5-6 days. But it's good practice to keep at least 10 to 15 days at hand. Anyways, it is encouraged that you apply a few months earlier, not because it's a lengthy process, but because we'd like you all to be much better prepared with your finances by applying a few months early. So on an average, at HDFC Credila, we've seen that students start applying to us 6 to 8 months at least in advance. So somebody who's planning to go to US in July, August of this fall would probably have applied to us in October, November when he's starting his application process to the universities. So that's usually the typical cycle that they follow so that they can use the solvency letter there. A co-borrower flexibility is something which is not easily found, which means that the co-borrower who needs to come on board necessarily would need to be a parent. But there are organizations who will give you a flexibility of getting an uncle or a blood relative like a brother, etc., on board, or even add a second co-borrower. So it's not necessary that only one parent will come on board. It could be, say, a parent and an uncle or a parent and a brother on board, which increases your chances of getting a loan and a higher loan amount. So this flexibility is another thing you should check for. Similarly, a multi-city co-borrower flexibility is important because if you are going to apply to your bank branch and you based in one city, maybe you're working in one city and your co-borrower is sitting in the second city, your collateral is in a third, and these are very common situations to find. I mean, we find this all the time because students would end up going to college in a separate city and, not be living with their parents. Now, this should not become a hindrance to application. So here is where checking on co-borrower flexibility, which means is that company going to ensure that they coordinate between the co-borrower, the applicant, and also check on collaterals which may be in a different city and, do the verification there. So we find these common situations very easy to handle because it's just so commonly found. So nothing to worry out there, but if the loan provider is not flexible with this, and if you do have everybody in different cities, then this could be a cause of concern. Unsecured loans is something that everybody wants, that, you don't need to give a collateral. And so unsecured loans are available up to, it's a range that is available. Some financial institutions don't give you unsecured loan. Some of them will give you maybe up to about 20-30 lakhs. And so we've seen that up to about 45-50 lakhs is a common higher amount of unsecured loan that is available, that students can get. A huge chunk of students at HDFC Credila we've seen have availed unsecured loans. This is based on your profile, so you need to be eligible for this. And it definitely fastens up your process also if you're getting an unsecured loan because there's no collateral check. Now, while you're planning to apply for a loan, what you need to look at is how much of a loan should I really be taking? Because the amount that you are going to ask for, you need to be comfortable that you will be able to pay that with ease. Now, we understand that in your initial few years, you will be earning a certain amount, and that is only going to increase over the years. So it's a good practice to actually apply for a loan where you can pay back in a longer tenor. So up to 15 years is what's the upper cap on the repayment tenor. There are companies who will give you options up to, say, maybe 7 years, 10 years, but many people need loans for, up to even a couple of crores. It may be, 70-80 lakhs, and you may find that this is a huge chunk for me to pay if I'm going to pay this back in 6-7 years. So it's good to check how much that loan tenure can be, because it can be up to 15 years. And that makes it very easy for you to pay back in smaller EMIs. However, this doesn't bind you from, say, even pre-closing a loan or even, preponing this. You may realize that it's very easy now for me to pay back this loan after you got your job, and you realize, this is great. I can probably pay back in 6-7 years instead of the earlier 10 years or 12 years that I opted for. So you can inform the financial provider you took the loan from, and you can pay back in a shorter time. But in the initial stage, it is good for you to take a longer tenor. Now, this is a comparison which is not very easily found, because when you look at education loan companies in India versus some dollar loan companies, which are basically non-Indian companies, how do you compare both? Because we've, often seen students come back and say, I am getting a loan, there is no co-borrow on board, and it may also be unsecured, but how does it really compare? Does it make financial sense to opt for that? And this is something that we'd wanted you to compare and realize what option you should be choosing and how to really make that decision. So firstly, when you take a loan from a company, in an Indian company per se, you can get unsecured loans. There is a option available of getting a loan without an upper cap. So if you're going for grad, for example, for undergrad, you could need even 2.5 crores for your education. So there is no upper cap on the loan. Whereas the dollar loan companies have a upper cap and they cover only tuition fee. Whereas here you get the option of covering tuition fee, living cost, other costs that are involved. There are also tax benefits which are not available with the dollar loan company. So like I was saying, technically an effective rate of interest, if you're taking a loan of at 11% is 8%. So that makes it very, very competitive. The processing fees are lower from Indian companies in comparison. Also, when you avail of a loan in INR, and you're going to earn in USD and pay back after converting your USD into INR, you will always gain by that conversion. So it makes sense, and that gain can actually help you, save 2-3% in the whole process, depending on the conversion rate that is going on there. So it makes a lot of sense for you to take a loan in INR. So when you take a loan in INR, there is of course a forex conversion that happens when we are transferring the fee to the university, and all these things are taken care of by the Indian companies. It's like an automated process that happens. That's not something that the applicant needs to get involved in. Also, the the education loan approval that we were just talking about, the benefits of doing this before you have got your I-20s or your admit letters, this option is available only with the INR, the Indian loan companies, and not the foreign loan companies. Also, the entire loan amount that you need is not sanctioned by the dollar loan companies. They will sanction for the first semester, and then based on your performance, there'll be a reevaluation, which means that there is a chance you may not get the loan for that. Whereas with the Indian loan companies, they will sanction the entire amount, and then you can choose how much of a loan you would need for your education. Effectively, when we go to the next slide, you will be able to see this little calculation that we've done for you. It's just the approximate numbers that we've put out there for you to realize how this works out for you in terms of saving when you take a loan from an Indian company versus USD companies. Of course, all Indian loan companies do not have the same terms. So for example's sake here, I have used what HDFC Credila offers. But you would need to look at nuances like those, whether tax benefits are available by the company that you're applying to or not, etc. So of course those are checks that you will need to make. But if you look at what is generally available to you, what is possible from an Indian loan company versus USD, this is what it comes to. So there is saving also. It effectively becomes a smarter decision for you to take a loan from an Indian company. So that's all I have here. I'll be happy to take any questions that you may have for me. You can bring it on. Can you elaborate on the terms co-borrower and collateral? So co-borrower is basically like a guarantor to your loan. So hence a parent or a blood relative, somebody who's guaranteeing that if you are not getting your job and you are not being able to pay your loan, then they will pay this on your behalf. So that's what a co-borrower basically is for. A collateral is a security that you are giving with your loan to comfort that in case you are unable to pay, there is a security from your side that you have put against the loan, saying that, here is a FD, you can liquidate my FD if I default on my loan. So these are just backup securities that you are giving when you are availing of a loan. So that's what it really means. But the good news is that, we ourselves experience that students do not really usually face issues. We've seen people take very good decisions about what course they want to go to, how much they want to invest behind this education. They plan their finances well. So the default on loan that we have seen, doesn't exist. People are very conscious about building a positive credit history, taking very conscious decisions about finance. It's a very important decision. And at a young age, you're taking it. So hence we say start early, take all the help, talk to us. We will recommend also what will work there for you in terms of your planning. It's best not to overstretch. But when you are keen and know that you are capable, you're getting into a top university, you need to invest a big chunk there, then, we are there to support you, because your scores, your capability in itself is something that shows out there that, you will be able to get that job and pay back your loan and for your education. If I pre-close my loan, is there an extra amount that I need to pay is one question. No, you do not need to pay an extra amount. So you can pre-close the loan. That option is there without an extra charge. It's available. What is the eligibility criteria for unsecured loan? I think I answered that. So basically, the student's profile has a very strong role to play in that. What country you're going to, which university, the ranking, the course, the employability of that particular course. These are things that we look at. And of course, there is a co-borrower whose profile is looked at, but student profile has a very large role to play in the unsecured loan that we give. What happens if I get my sanction but don't get any admit? Well, if you get a loan sanction and don't get an admit, then you have an option. Like we said, it is not compulsory for you to avail that loan. So if you do go through an unfortunate situation like that, then you do not need to take the loan disbursement. But what you can do probably is apply again. And if you're planning to do that, then this loan sanction that you've already got, and if supposing the same criteria are there, you've applied to the same university, courses, etc., then this loan sanction is something that will hold good, and you will be able to, go to that financial institution and say that it was sanctioned in the past. It makes your case stronger. Maybe even a reevaluation is not required if the base does not change in your application parameters. Planning for masters in 2023 and taking GRE in 22 June. When should I start applying for loan? Well, what you should do is apply soon after your GRE scores are out, because only then will you have clarity about which universities you can apply to. And that's generally a good practice. That's what we recommend. Do my 10th and 12th standard marks matter? Well, past academic records are considered. It is one part of the criteria that we consider. It's not the only criteria, but yes, past academic records are considered. And it also depends on, what you are really looking at. So if you are going for undergrad overseas, your 10, 12 marks are very, very relevant. If you are going, say, for a PG or a doctorate or something, then, obviously this was many years back. So the weightage given to that would be lower. If my parents are retired from job, will I get a loan up to 40 to 50 lakhs? Well, we have seen that many students who apply have parents who have retired. And that's where we look at the overall co-borrower profile. There are many things that we consider when we look at the co-borrower profile. Firstly, you may just get that loan that you're talking about purely on your profile. And it could be an unsecured loan too. So you should not close this option just because, your parents are retired. And like I said, many applications that come to us have parents who retired, and students do get that loan. So of course, it's an overall evaluation we need to do, but many, many students get a loan under such situations. if I want to take a loan worth 50 lakhs, how much should the collateral property be worth? Now, I'll answer this specifically to HDFC Credila. So what happens with other financial institutions is that they may ask for the property value to be 100% of the total value of the loan, or even a little higher. But with HDFC Credila, we also consider a property value which may be a little lower than the overall loan that we are sanctioning to you. So that option does open up. So loan repayment has three parts. Firstly, your loan repayment starts after you have finished your course, and there's also a 6 months grace period given to students, just in case you haven't got your job. However, we, for some students, recommend starting a simple interest, just the basic interest part, that component, right from the beginning. So the benefit of that is that there is a small amount of money that you are paying, which even your parents could pay. And that reduces the burden later from the entire loan amount that you would need to pay. But the principal amount repayment only starts later after your course is completed, and in case you need the grace period also to be availed. So that's one. Who's going to pay the loan? The loan could be paid by you after you've got your job and you want to pay that back. In case you initially want to take that help from your parents, you could take that. So it is your choice there. That is not something that we dictate as to, whether your parents or your parents could start off in the initial years. You may want to take it on later. That option is given to you. You just need to change the modalities of repayment and inform us about that. And that can always be switched.
Can you give us an approximation? Like, let's say a student takes, like, say, 50 lakhs loan or something. What is an approximate amount they might have to pay monthly, to count towards that simple interest repayment?
So that would really depend on the entire loan amount that you're taking. So there are two components there. One is the loan amount that you're taking, and the other is interest rate. So typically it comes to just a few thousands. It could be a range from 2,000 to 6,000-7,000 depending on the amount of loan that you've taken. So it's a very small amount that you need to pay monthly. Can we keep multiple collaterals if parents are retired? When you look at collaterals, two common collaterals are FDs and property. Now the property should not be for it should not be for commercial purpose. It needs to be, say, like a home property or a land which is not for commercial purpose. We have not really come across situations where two properties really need to be added onto the collateral. So we consider that in case it is required, then that is an option that can always be considered. But this is not a very common situation to have. Also, like I said, it is not necessary for your entire collateral amount to be equal to the amount of loan that you are taking. So flexibilities there are also considered. So if you're going to pay directly from the US account, no, you can't, because these are tax benefits for India. However, what people do is that they do have an Indian account on their name, right? I mean, they are Indian citizens per se. And if you're paying through that account, then you can avail the tax benefits because it's technically through the Indian account that you have. And, as an Indian citizen, you are availing that benefit. So yes, a good question. If you're paying directly through your US account there, no, you do not get these benefits.
Okay, so then it's possible for me, let's say if my dad is in India and he's earning some, say, 10 lakhs a year or something. And yes, if I'm in the US and I graduate, I get a job and I want to pay back my loan, and I cannot avail the income tax benefits on my US dollar income. So I can just send the money, whatever I want to pay back on my loan, to him. Yes. He can send it from his account and he can avail that tax benefit on benefit on his income, right?
Absolutely. I mean, parents can pay and parents can avail of the tax benefit. So that option is available.
Perfect.
What are the documents the co-borrower has to produce? The co-borrower needs to give KYC documents, income documents. These are the two common ones. that he specifically needs to produce. There is a document checklist that is available on our website too. I'd recommend that you have a look at it. It's pretty comprehensively built. We've also split there between, supposing you're from a service background versus a business background, what are the documents that are required? So that's given in detail. These are usually common documents. So what you find there is what most financial institutions will also ask for. So we actually find that people stretch this to about 7-8 years and like to stretch it to 7-8 years, not because they're not capable of closing this early, but because your tax benefits are available for 8 years. And this is a very attractive thing. So, even with home loan, people do that. So you take a home loan, not always because you don't have enough funds to buy that house. The people take the home loan because there are tax benefits on it. Same thing for education loan. People will keep it and stretch it for 7-8 years so that they can avail of this benefit, because it is rare to get this kind of a benefit on any loan, right? Having said that, we have seen many students come back with requests and say we want to close it in 5 years or so. So it's very common for us to get those kind of requests also to be able to pay back. So when you look at payback capabilities, I think the payback capabilities are high, but the want to keep the loan is what keeps them going. Well, we will need to consider how much of a loan you have taken and how much more you're eligible for. So every time a loan is given, there is a cap. So for example, your parents may have taken a loan for a house. That doesn't mean that they will not get a personal loan. That doesn't mean they will not get a car loan. There is an evaluation which is done, seeing how much is a certain person capable of paying back. And it's on the basis of that you decide whether you will get a loan or not. So supposing you are, your profile allows you to get a loan up to say 1 crore. And currently what you have availed in the form of a loan is 30 lakhs, which means that there is still that 70 lakhs which you can easily pay back. In your evaluation, it will come out clearly. So yes, you can take another loan on the basis of that. But any loan provider will look at how much loan you've taken, what's the ease of paying that additional that you will opt for. So what is HDFC Credila's interest rate? And I'll come to that because it's interesting and I haven't answered that really. So we give a range of an interest rate. We do not have one specific interest rate where we say here is a 11% and everybody now needs to take a loan at 11%. What we do is we take application and we say, are you eligible to get a loan at maybe 10 and a half, lower, or should we stretch and make the effort of giving you a loan, even though your profile may be a little weaker, you may get a loan at a little higher rate, but you will get the loan. And that is where the tailor-made solutions from loan providers come in handy, that a larger chunk of students end up getting a loan, and that too at a lower interest rate. So that's how we typically work. Having said that, there are education loan companies who will have a fixed interest rate. So whether you fall in the bucket in terms of the eligibility or not is something that they will decide. And if you don't, then you will either not get the loan or you'll get it at these fixed interest rate that they will have. But having the flexibility there definitely helps, because it increases your chances and you also end up getting loans at a more attractive rate. So our range at HDFC Credila on an average is about 11.5%. Having said that, there are many who get loans at a lower rate than that. This is just an approximate average that I'm giving you, 11.5%.
So thank you guys so much for attending. I will be sending you the replay link within 24 hours. So stay tuned for that. Thank you guys so much and take care. Thank you, Ms. Chandini, for coming on the channel and coming on the page. It was awesome. I learned a lot too, and I hope that you had fun as well.
Thank you. Thank you so much. Yes, always a pleasure. And I hope this session helped. And all the best to all of you. May all your education dreams come true. And I hope we can help you in the process.
All right, guys. Take care. Have a good night. Bye.
Thank you.